Three stocks we're covering today jumped over 20% this week. Not this month, this week.
And all five stocks we're breaking down are up triple digits in 2025. One of them is up 657% year to date.
657%. And here's what's insane. They're all connected to the same megatrend that nobody's paying attention to.
We're going 5-to-1, saving the biggest mover for last. And trust me, number one is controversial. Let's go.
Stock number 5, SoFi Technologies, ticker SOFI, up 8% this week, up 260% year to date.
Okay, so everyone knows SoFi as the student loan company, but that's not what they are anymore.
What are they now?
They're a full-stack fintech platform. Banking, investing, loans, credit cards. They're building a one-stop financial app for millennials and Gen Z.
And they just had a record quarter.
Massive. They added 905,000 new members in Q3, a quarterly record. Total membership hit 12.6 million. And revenue crushed expectations, $950 million versus $889 expected.
That's a big beat.
And here's the kicker. Adjusted earnings per share doubled year over year, 11 cents versus 8 cents expected. This isn't a money-losing growth story anymore. They're profitable.
What's driving the growth?
Loan originations are exploding. Personal loans up 53% to $7.5 billion, a record. Student loans up 58%. Home loans doubled year over year, and their loan platform business, where they connect private credit partners, surged 250%.
250%?
The private credit boom is real, and SoFi's positioned perfectly. Plus, credit quality is improving, lowest charge-off rates in over 2 years.
So what's the bear case? Because this sounds too good.
Recession risk. If unemployment rises and consumers default, SoFi's loan book gets hit. And at a $37 billion market cap, expectations are sky high. Any stumble crushes the stock.
But if the economy holds,
then SoFi keeps scaling. CEO Anthony Noto said they're investing aggressively in crypto, blockchain, and AI. They're playing offense, not defense.
Number 5, SoFi, the fintech disruptor that's way more than student loans. Now let's talk about the stock that jumped 23% this week.
Stock number 4, Bloom Energy, ticker BE, $134 per share, up 23% this week, up 494% year to date. And it hit an all-time high of 144 this week.
Okay, so what does Bloom Energy do?
They make solid oxide fuel cells, basically on-site power generators for data centers, factories, and critical infrastructure.
And why did it explode 23% this week?
Earnings. Q3 revenue hit $519 million, up 57% year over year, and way above the $427 million Wall Street expected. Adjusted earnings crushed too, 15 cents versus 9 cents expected.
So they beat on revenue and earnings.
By massive amounts. And they generated $137 million in free cash flow, a complete turnaround from burning $83 million last year.
What changed?
The AI data center boom changed everything. 2 weeks ago, Bloom announced a $5 billion partnership with Brookfield Asset Management to power AI data centers.
$5 billion?
Brookfield's building AI factories around the world, and Bloom became their preferred on-site power provider. That's a multi-year revenue pipeline locked in.
So why do AI data centers need Bloom?
Because access to power is now the #1 bottleneck for AI. These data centers need reliable 24/7 electricity, and the grid can't handle it. Nuclear takes a decade to build. Gas turbines take 3 years. Bloom's fuel cells can be deployed in 90 days.
That's the whole value prop?
Exactly. And they've got deals with Oracle, American Electric Power for 1 gigawatt, and Equinix for over 100 megawatts across 19 data centers. This isn't speculative. It's happening now.
What's the risk?
Valuation. They're trading at over 1,000 times earnings. If AI data center spending slows or natural gas prices spike, Bloom gets crushed.
But if AI keeps accelerating?
Bloom's in the perfect spot. They're solving the power crisis that's holding back the entire AI industry.
Number 4, Bloom Energy, up 23% this week on the AI power boom. Now let's get to number 3. which is the gold standard of data center infrastructure.
Number 3, Vertiv Holdings, ticker VRT, up 272% year-to-date.
And Jim Cramer just called their products the gold standard for data center cooling.
What does Vertiv do?
They make the cooling systems, power distribution, and racks that keep data centers from melting. If you're building an AI data center, you need Vertiv equipment.
And they crush earnings?
Demolished. Q3 revenue hit $2.676 billion, beating expectations. Adjusted earnings per share came in at $1.24, way above forecasts. And they raised full-year guidance to $4.10 per share.
What's driving this?
AI chips generate insane heat. NVIDIA's H100 GPUs run so hot that traditional cooling can't handle it. Vertiv's Liebert air conditioning systems are the industry standard.
That's why Cramer called it the gold standard.
Exactly. He said data centers experience extreme temperatures, incredibly hot, then suddenly freezing. The cooling is managed by Liebert air conditioners, and Liebert is regarded as the gold standard.
So they're the picks and shovels of AI infrastructure.
Totally. Whether Microsoft, Google, or Meta is building data centers, they all need Vertiv. And organic orders surged 60% year over year.
60% order growth?
The backlog is massive, and they expanded their partnership with NVIDIA for 800-volt power systems designed specifically for AI workloads.
What's the valuation?
Expensive. 75 times earnings. But they're projecting $13.9 billion in revenue by 2028. That's 15% annual growth.
What's the bear case?
If AI data center spending stalls, Vertiv's growth evaporates overnight. And at 75 times earnings, any disappointment triggers a sell-off.
But if AI infrastructure keeps booming,
then Vertiv's still early innings. This is a multi-year build-out cycle, and they're positioned perfectly.
Number 3, Vertiv, the cooling systems keeping AI from overheating. Now we're getting to the really wild ones. Number 2 jumped 24% this week.
Stock number 2, Seagate Technology, ticker STX, $265.62 per share, up 24% this week, up 204% year-to-date.
24% in 1 week?
After crushing earnings. This is a data storage company that just became the hottest AI play nobody's talking about.
Wait, Seagate makes hard drives, right? Isn't that old technology?
That's what everyone thinks, but here's the twist. AI is creating a data storage crisis, and hard drives are the solution.
How is that possible?
AI models need massive amounts of data storage. Think videos, images, training data sets. This data isn't accessed constantly, so it sits in cold storage. And hard disk drives are way cheaper than SSDs for storing huge amounts of data long-term.
So AI is driving hard drive demand.
Massively. Seagate CEO said the data center end market represented 80% of overall revenue, and they're selling high-capacity nearline drives to cloud giants.
What were the earnings numbers?
Revenue up 21% to $2.63 billion, beating expectations. Adjusted earnings per share, $2.61 versus $2.40 expected. And operating margin expanded to 26.4% from 18.6% last year.
That's huge margin expansion.
And guidance for next quarter is even better. $2.7 billion at the midpoint versus $2.65 expected.
What's the secret sauce?
HAMR technology, heat-assisted magnetic recording. It lets them pack way more data onto each drive. And Seagate's production is largely committed under build-to-order contracts through calendar 2026. Revenue visibility is locked in.
What did analysts do?
Mizuho raised their price target to $280. Loop Capital went to $350. That's 32% upside from here.
What's the risk?
If cloud spending slows or flash storage prices crash, hard drive demand drops. And Seagate's trading at a premium valuation now after the run-up.
But if AI keeps generating data,
then Seagate wins. Cold storage demand is structural, and they're the leader.
Number 2, Seagate, the old school tech stock riding the AI data wave. Now let's get to number 1, the most controversial pick. Number 1, Grail, ticker GARL, around $90 per share, up 657% year-to-date.
Wait, it's down this week?
Down 7%, but still trading near its 52-week high. And it's the most polarizing stock on this list.
Okay, so what does Grail do?
They're developing a blood test that can detect over 50 types of cancer early before symptoms appear.
That's huge if it works.
Their flagship product is called GRAL. One blood test, multiple cancers detected. The idea is revolutionary.
So why is this controversial?
Because they're not profitable. They reported a net loss of $2 billion in the trailing year. Revenues only $125 million, growing 35%.
Yikes, that's a rough profile.
And the stock's up 657% this year on pure speculation about the addressable market.
What's the bull case?
Early cancer detection is a massive unmet need. Most cancers are discovered too late when treatment options are limited. If GRAL works at scale, the market opportunity is tens of billions.
What's the bear case?
Everything. Profitability is years away, insurance reimbursement isn't guaranteed, and analysts are divided. 12 buy ratings, 12 holds, 3 sells. The average price target is $61.50, which is 27% below the current price.
So Wall Street thinks it's overvalued.
Most do. The RSI is at 66, overbought territory, and the 7% pullback this week might be profit-taking after the 657% run.
So why is this number one?
Because it's the highest risk, highest reward play on the list. This is a binary bet. Either GRAL transforms cancer detection and becomes a $100 billion company, or the hype fades and it crashes.
Who should own this?
Only aggressive investors who can afford to lose the entire position. This is a small allocation in a diversified portfolio, not a core holding. Number 1, GRAL, the controversial cancer detection biotech that's either going to the moon or back to Earth.
All right, quick recap. 5 stocks, all up triple digits in 2025.
SoFi, the Fintech platform crushing it. Bloom Energy, solving AI's power crisis. Vertiv, cooling the AI revolution. Seagate, storing all the data. And Grail, the cancer moonshot.
3 of them jumped over 13% just this week. All of them are riding the AI infrastructure megatrend, except Grail, which is its own category.
Now, before we wrap up, quick disclaimer. Nothing we've discussed today is financial advice. We're analyzing these stocks for educational purposes only. Always do your own research and consider talking to a financial advisor before making any investment decisions.
These are high-momentum, volatile stocks. Past performance doesn't guarantee future results, and you could lose money. Only invest what you can afford to lose.
With that said, here's the question. Which one are you most bullish on? Drop your pick in the comments. Are you playing it safe with Seagate or Vertiv, going aggressive with Bloom, or taking the wild bet on Grail?
If this breakdown was valuable, hit that like button and subscribe. We're doing these deep dives every week. See you in the next one.